So this week, I wanted to just go through modern portfolio theory because I think it's cool. I will say it's a pretty heavy segment. We're going to be going into the math in detail, and I'm not expecting anybody to take this segment and go replicate it. That's kind of not the point, but I really wanted to use this to build some intuition around quantitative strategies and really one of the foundational theories of quantitative finance. So I thought it'd be interesting. I do want to see this in a spreadsheet one day, maybe even next week, so that people can do a little bit of this themselves. But for now, I just wanted to build that intuition because this was a very important theory in quantitative finance. And hopefully it'll teach you guys some cool stuff about how to think. So to introduce, modern portfolio theory is a quantitative framework that was developed in the 1950s. It focuses on portfolio selection. And while quantitative portfolio management has changed a lot since then, modern portfolio theory still forms the basis for a lot of those ideas that a lot of modern techniques are kind of based on, or more recent techniques are based on. So this is going to get into some kind of heavy math. But the overall goal is to leave with some kind of intuition for how this portfolio selection process works. It shows a lot of very cool ideas, although I don't expect anybody to take this segment and kind of run with it and do it themselves necessarily. Again, I would like to create a spreadsheet that would allow you to do some of this analysis yourself. But for now, this is really just building intuition for a pretty cool quantitative process. This is kind of a step-by-step guide of modern portfolio theory, which I was not able to find myself. So I thought I would find this useful. Maybe you guys will too. So let's get into it. So modern portfolio theory was first introduced in 1952 by Harry Markowitz as a quantitative method for selecting a portfolio with a desired risk-return profile. You know, a lot of people who watch this show, a lot of them are options traders. We very highly value being able to have more control over our risk-reward profile than just trading stock. And this theory uses diversification to tune a portfolio to your desired risk-reward level, specifically to find a portfolio that maximizes expected return for a specific level of risk. But we're going to go through the steps of modern portfolio theory. Hopefully, each one of these steps are going to make a little bit more sense once we've talked about them. I just kind of laid them out here. We're going to be talking about some very cool concepts, including covariance matrices. So you guys are going to sound really cool at parties, talking about your knowledge of linear algebra, hopefully, when you walk away from this. But the first step is determining what assets are going to be included in the portfolio, which is kind of a zeroth step of modern portfolio theory. We kind of assume going into that you already have an idea of what assets you want to include. And there's a bunch of different ways that you can kind of go about personalizing that process. Really, it's up to you to determine the selection criteria for what goes into a portfolio. But because modern portfolio theory uses diversification to really control exposure, it's pretty good to pick a wide variety of assets. Specifically, we've talked about diversification before, but assets that kind of span a variety of asset classes, sectors, risk profiles, market caps, regions, for example. Noting that portfolios can also become over-diversified, which can result in diminished returns long-term, but we still really want a good amount of diversification. When I say good, depends on you and your personal goals. But for this example, we're going to assume that a target portfolio is going to contain 5 elements. Typically, I'd say a lot of portfolios would contain more than that, but we're just going to stick with 5 for now. We're going to look at SPY, the Qs, IWM, Gold, and Apple. Make sense?
Yes.
Easy peasy. So that's asset selection. Now we go on to the kind of first step, and I'm going to change this again. First step, which is calculate the expected return of each asset. And this is where the mathematics kind of comes in a little bit more. Expected returns. I think this is going to be based on historical price data, as I'll talk about in a second. We know the caveats of historical price data. Obviously, the market today is totally different than the market from a year ago, a month ago, and even yesterday. But that's going to form, just as a heads up, the basis for a lot of these calculations. Make sense?
Yep.
So step 1, calculate the expected returns for each asset that's going to go into your target portfolio. So in modern portfolio theory, right, future expected return is going to be calculated from historical returns data. So in that kind of lower left-hand corner, I have the returns data from 2020 to 2023. We're just going to use that in this example for those 5 assets that we want in our target portfolio. So you want to find a date range that's sort of suitable here, just kind of randomly picked 2020 to 2023. But the first step is we're going to take that returns data, or that price data, and convert it into returns. So daily returns from the price data should be hopefully pretty easy. Then to get our expected returns, we're going to calculate the mean daily returns for each asset during our look back period, again, 2020 to 2023. And then we're going to annualize it by multiplying it by 252 And what's going to give us is our expected annual returns for each asset in our portfolio. So for Apple, it's like 26% approximately. For gold, it's about 7%. For IWM, it's about 8%, and so on. Hopefully pretty simple so far. See, we just did our first step of our modern portfolio theory. We calculated our expected returns annualized for each asset in our target portfolio. Okay, now that we have our expected returns, we're going to get into our first, I'd say like pretty complicated step. We're going to be using linear algebra to describe this, but hopefully again, the point of this is like build a little bit of intuition. So hopefully, even though we're going to be using the language of linear algebra, this will make sense. But the next step is going to be calculating the covariance matrix of returns for these selected assets. We've already calculated the expected return. Now we're going to construct our covariance matrix. And what exactly that means, let's start with the first word, covariance. So covariance, the intuition behind it is it basically measures the joint variability of two different variables. It's very similar to correlation. Correlation is basically the normalized version of covariance. So correlation will tell you the strength and direction of a linear relationship between two variables. Covariance will really just tell you the direction because it is not the normalized version. Effectively, a way to think about this is joint variability. I think that kind of makes the most sense. But it effectively really measures that directional relationship where if you have like positive covariance, means when one asset goes up, the other tends to go up. When you have negative covariance, they tend to be inversely related. This is effectively how we're going to quantify risk. When we talk about risk, we talk about uncertainty, we talk about variance, we talk about variability, we talk about volatility. There's a lot of common themes between all of those words. And so covariance is really how we're going to represent like sort of risk or volatility in this modern portfolio theory framework. It's a little bit confusing. I did include the math here. All that you need to know is covariance. So we talk about volatility, right?
Yes.
So volatility is standard deviation, right? If we talk about daily returns volatility, we're really just taking the standard deviation of this returns data, right? Variance is just standard deviation squared, right? So if you think about that relationship, these are just statistical tools for measuring risk. When we talk about covariance, it's specifically the joint volatility as a way to think about it between two variables. It's difficult to kind of talk about this in detail without getting into the mathematical weeds, but effectively what we're trying to capture with covariance is the sort of risks between a pair of assets. Think of it as very similar to correlation, which hopefully you guys already have a pretty good intuition for. Does that make sense?
Yeah.
Okay. So we got the first word, covariance. Let's get to the second word, matrix. So matrix comes from linear algebra. It's technically an array of numbers or variables that are organized into rows and columns. But for the purposes of this segment, effectively a way to think about it is just a way to structure data that makes calculations or mathematical expressions a lot easier to work with. A matrix, all that really means is just a way to write out the data, a way to structure the data so that it's mathematically and computationally a little bit easier to work with. So when we have a covariance matrix, this is just going to be a matrix of the different covariances between different variables. Again, remembering that covariance is very similar to correlation. So this is our covariance matrix, right? Where you have Apple, gold, IWM, QQQ, and SPY, right? All of our different variables. Each cell is going to be the covariance between the pair. So for gold and Apple, for example, this cell right here, that's the covariance from that calculation on the previous slide between gold and Apple. So remember that is a way to kind of quantify the joint variability between those two variables. Again, thinking of them as being very similar to correlation. If you have the covariance of a variable with itself, this is simply the variance, which we should also hopefully have a good understanding of because it's just the squared version of volatility. When we talk about a covariance matrix, it's a lot of big words, but effectively what we're trying to construct here is basically a table that quantifies the, let's just say, risk factors associated between pairs of elements in our portfolio, where we have Apple, gold, IWM, QQQ, SPY. This table is just going to have those covariance values between the different pairs. And if you have a variable with itself, the covariance of a variable with a variable is simply just the variance, which again is just the standard deviation squared. When we think of covariance matrix, just think of that as like a table that kind of tells us about the risks between the different pairs of elements in our portfolio. That's all this really is. Make sense?
Makes sense.
Hopefully as much sense as it can make. Again, we're we're using concepts from linear algebra, which if you've never seen before, that's pretty sick, actually. Yeah. So you guys, again, can sound very cool at parties talking about your covariance matrices from linear algebra. But again, we're looking at the covariances between all of our different pairs. For the covariances with the date ranges that I showed you before, 2020 to 2023, this is our covariance matrix. It's, again, looking at the different covariances between the different pairs. Is, again, a way to measure our risks and the risks that kind of come from an individual's returns themselves, as well as the risks that come from the correlation between the pairs. Again, the goal of this is not for you to take these concepts and go do them yourselves. Although, again, I'd like these to be in a spreadsheet someday, but at least to get an idea of like some of the background processes that might be happening with some quantitative analysis. In this formalism, we have a way to, 1, calculate our expected return. That was step 1. Step 2, calculate the covariance matrix for the returns of the selected assets. And when we hear covariance matrix, what we should think is like it's a table of data that tells you about risk, where the diagonal values are going to tell you about the risk of the individual asset, and the off-diagonal values are going to tell you about the risks that kind of arise from the correlation between the assets. Think of it kind of that way, right? It's just a table that looks at the different risks, possible directional risks in our portfolio. So now that we have a way to measure expected reward and we have a way to measure expected risk, now comes to our next step, part 3, which is we're going to find a bunch of different possible weights. I mean, like a couple thousand of different possible weights for our 5 elements in our portfolio that we've chosen. Now that we have a way to calculate expected return and a way to calculate expected risk, we're going to calculate all of those different expected risks and rewards for those different weights. So that basically tells us that if we were to simulate, kind of back test all these different portfolios, what would the risks and rewards be? And what can we kind of expect in the future? I'll get into that more, but does that kind of make sense?
Yes.
Cool. Let's get into it. So now we have to define different weights. So these are usually just kind of randomly designed again, or randomly calculated. Again, we want like a couple thousand. Think of this as kind of like simulating different portfolios is a way to think about it. So we have Apple, Gold, IWM, QQQ, and SPY. For portfolio 1, for example, we're going to have these weights. So 26% is going to be Apple, 18% is going to be Gold, 11% is going to be the Russell, and so on. Portfolio 2, we're just going to have another random configuration of possible weights. The only actual rule is that the sum has to sum to 1. If I take all of these different weights and I add them together, I should get 1, because we want this portfolio to be fully allocated, right?
Yes.
We don't want it to be bigger than 1. That would be bad news bears. We don't want that. But we come up, again, through computational methods with usually like a couple thousand different possible weight configurations. And now we have all of the different pieces to be able to construct our efficient frontier, which I'll get into in a second. But we got weights, right? Which, again, these are different weights for our portfolio, different possible weights. We have our expected returns, and we have our covariance matrix, which, again, is this kind of table that tells us about the risks of the different elements themselves and the kind of correlation risk between them. Now we can actually test expected risk and return for different possible portfolios using these weights that we made up. Let's look at an example. So again, we have Apple, Gold, IWM, the Qs, and SPY. For our first example, we got portfolio weights of 26%, 18%, 11%, 27%, etc. So now to calculate the expected return of the portfolio, it's actually pretty simple. You just multiply the weight by the expected return, and then add all those different multiplications together. That gives you, if you actually work out the numbers, it's about 0.138 is what you get. So now we have our expected return for portfolio 1 with, again, these randomly defined weights. Expected risk is a little bit more complicated. This is where the linear algebra kind of comes in. Again, linear algebra is basically a way to represent data that makes it a lot easier to work with. But what we're effectively going to do is we're going to take our covariance matrix, we're going to take our weights, we're going to do this calculation, which is a transformed versions of the weights times the covariance matrix times the weights. Square root of that gives you the variance. All that we really need to know is that we're effectively taking a weighted volatility contribution from each asset and sort of using that to estimate the expected volatility of the portfolio. We're saying each element has its own volatility. We're going to take that into account. And now there's this also kind of joint volatility between each different pair. Through this calculation that I don't want to get into because it's kind of in the weeds, we're going to look at sort of the weighted contributions from these different risk factors for each element. It's actually very similar to the expected returns calculation, but risk is just a little bit more complicated of a calculation. It's kind of the same, functionally something very similar that's going on here. We have our portfolio one. Remember, portfolio one has these weights, 26%, 18%, 11%. We have our expected return for the portfolio. We have our expected risk for the portfolio, which if you work out the numbers, it's 0.247. So now we have the expected risk and the expected reward for one portfolio. And then when we want to continue, so we have for one portfolio, we just remember that. We have our expected risk and our expected return for these weights. Now we're going to repeat that process for all of these different weights, right? For thousands and thousands of different combinations. We're now going to calculate expected risk and expected reward for all of those different portfolios, okay? And that's how we actually get to our next step. Our next step, which is to construct our efficient frontier. So efficient frontier, it's usually done with a plot. So if I take that expected risk and expected return for a certain series of weights, I plot it, and I repeat that a couple thousand times with all of these different possible weights. That's how I get my efficient frontier. So each one of these dots is a portfolio with different weights. And the efficient frontier is basically the collection of portfolios that gives you the highest level of expected return rate on this y-axis for a given level of volatility. So I can go to, maybe I want 20, my volatility, my standard deviation is 0.25. I want to say, okay, so if I want 0.25, if that's the most risk that I want, what portfolio is going to give me the most expected return for that level of risk? You can go down this plot, pick which kind of volatility that you want. Again, noting that these were constructed with, historic price values. So you want to usually use more than that to actually make a decision. But this can give you an idea of what portfolio weights with the elements that you selected will give you the best possible expected return for the level of risk that you want. And so that finally brings us to our last step. This finally brings us to our last step, identify optimal portfolio or portfolios. So there's a bunch of different ways that you can do that. You have all this data to play around with. These dots are kind of colored by Sharpe ratio. So the more yellow, the higher the Sharpe ratio, the more purple, the lower the Sharpe ratio. So you can, for example, pick a portfolio with weights that yield the highest Sharpe ratio, or maybe the lowest risk. Or if there are other factors that you want to take into consideration, absolutely take those into consideration. But at least this hopefully gives you an idea of how to initialize those weights, at least again, based on historic data, to get a certain level of expected return for, I'd say, like the maximum amount of risk that you're really willing to tolerate. Hopefully that made sense. Hopefully you guys found it cool. I will say, yeah, definitely got into the weeds there. And again, I want to put this into a spreadsheet at some point because the math, believe it or not, is actually not too complicated exactly what's going on here. It just kind of looks a little gross if it's a style of math that maybe you're not familiar with. But to just kind of conclude, let's wrap it all up. So big takeaways: modern portfolio theory utilizes strategic diversification to maximize expected return for a given level of risk. By calculating expected portfolio of risk and return for different possible portfolio weights, you can actually put plot portfolios along the efficient frontier, or portfolios that offer the most return for a given level of risk, and identify them, and then choose maybe the weights or the portfolio configuration that makes the most sense for your risk tolerances and profit goals. And so while, again, this analysis is done with historic price data, and you always need to take that with a grain of salt, it can still offer insights into how to actually set your weights, because that's a very difficult process. Figuring out what goes into a portfolio is hard enough, but now you got to set weights for them. There are a bunch of different ways to do that. Modern portfolio theory is like one of the foundational theories around how to do that. I will say a lot of the methods have gotten better, have gotten cooler, because obviously there are some drawbacks with this that we haven't talked about, but it's still like such a foundational theory that I thought it'd be cool to cover. So I hope you guys enjoyed that.